Thanks very much, Orimus. So, good morning, good afternoon, good evening, wherever you are in the world watching into to us right now. It's a great pleasure to be here and to have my fellow panelists both live in the studio and online as well. So I'd like to start off by saying a little bit about what we'd like to do today with our panel, and I think first of all, I guess you've all really tuned into this to hear really good news that there's loads of funding out there, there's loads of money available, loads of dry powder to be burnt, and it's all ready to come and be attacked by your startup. So this is what we're going to discuss with the panel today. So, gentlemen, thank you all very much for joining from the different corners of the world. I think it would be great to kick off and hear a little bit about yourselves. So I'll ask you just to say a few words about yourselves and what you do yourselves. So, Balder, why don't we go straight over to you? Tell us a little bit about what is it that you do.
Perfect. Thank you, Alex. Thanks for the warm welcome here. Balder Bomans. I'm the Chief Investment Officer at Maven 11 Capital, based in Amsterdam. We are a full blockchain and crypto venture capitalist, focused mainly on layer ones, layer twos, and financial infrastructure. We manage a portfolio of liquid cryptocurrencies, which we deem special in terms of adoption for the coming 10 years, like Bitcoin and Ethereum, but also very much focused on early stage ventures and teams who are challenging the status quo when it comes down to technical challenges like scalability and other issues in our industry. We are a team of 3 partners here based out of Amsterdam and 2 analysts. And that's it.
Fantastic. Well, very warm welcome. Thanks for joining us. So on the other screen there, Kadeem, tell us a little bit about yourselves, please.
Yes. Yeah, so my name's Kadeem Clark. I'm based in New York. I'm the founder of Clark Global Marketing, which is a marketing firm that works with blockchain and other tech companies, along with traditional companies. A little bit about my background. I also come from the blockchain VC space, where I was the investment manager at A Decimal Capital. And in that firm, we kind of invested in layer 1 and layer 2 projects, focused on fintech. Following that, I spent some time at MarketX Ventures, where I helped ultra high net worth individuals invest into late stage private tech companies.
Super. Great to have you here as well. And then sitting next to me, we have Gitenis. So tell us about yourself.
Hi all, my name is Gitenis Galkis. I'm a partner at 70 Ventures, and 70 Ventures is an accelerator and a fund based out of Vilnius. We invest in B2B software as a service companies. However, a large part of our portfolio today is fintech, regtech companies, where we help from early stage to get to 1 million ARR and help them boost sales. So this is our key competence that we know. We are 3 partners, quite diverse, all living in Lithuania, but one of the partners is French, the other is Danish, and we have 2 associates. So really interested in looking to more pipeline.
Super, and I think for everybody out there, watching today, they're probably all very keen to hear what sort of ticket size do you all work with? Are they relevant for? Are you relevant for them watching in? So, just a quick one, Balder. What's your sweet spot, and what is the sort of range of ticket size that you do?
Yeah, so we are mainly focused on pre-seed stage ticket size wise. So I would say pre-seed, that's somewhere between 150 to 250K, and down to seed we can scale it up to 250 to 400K generally.
Okay, super. And Gitenis, for you?
So we invest up to 300,000 euros, mainly in all of the deals, or the most deals that we have made. We're not alone in those deals, so mostly it's syndicated. And when we come in, we bring the knowledge of sales, B2B outbound acceleration. So that's our angle in the consortium of investments that we have.
Mm-hmm. And a typical deal size, or?
It depends. It varies from, let's say, sometimes only 50,000 euros up to 500,000 or more.
Super. And Kadeem, what about you? What's your ticket size and your sweet spot in particular?
Right. I think my sweet spot is more so in the early to the mid stage. So I typically work with companies who are about to generate revenue or are doing that right now, and looking to raise around, let's say, $5 to $10 million from investors. I usually help companies with that.
Okay, super. So I think that gives people a really good flavor, out there listening and watching us right now, just to put that into context for them and the startups that people are working with and have out there. So a little bit, we're talking about life post COVID, what's actually happening out there. I was actually just coming back from Singapore in early February. Already people were sort of having their temperatures checked in the airports. Masks were already on, and I was thinking, this is going to all blow over pretty quickly. As we've seen, it hasn't blown over quite as quickly as we expected. What about for you guys? I mean, how did this hit you, and where were you? What was going on? First impact, Kadeem. What about you?
Yes. So I was actually in San Francisco at the time. I was living there before I moved back to New York, and I was going to take like a short trip home back to New York for the holidays. And following everything that happened, I ended up just moving here permanently.
Okay, so almost stranded or set back on the other side of the country. Yeah. And Balder,
Exactly.
What about you?
Well, how did we experience that? Indeed. So obviously, the Bitcoin is like sort of the temperature meter of the blockchain and crypto industry, I would say. And that night or that 13th of March, when everything was cascading down, Bitcoin I think had a drop of over 50% overnight, which was actually quite hectic. I mean, it almost sort of went to zero. This was more due to a market structure failure than obviously due to fundamental pricing. Quickly recovered in the weeks after. And I think generally what we have done after is that we reached out to our portfolio companies, how they are going to be fitted and how they see the future and their financing needs for the short to medium term.
Okay. And Giteni, your story?
To be in Kazakhstan on the 14th, so I'm happy the borders closed before. Otherwise, I might have been stranded in Kazakhstan for 2 months. But also on the verge of actually the 15th of March, we signed three investments. So all are live and kicking. So I guess let's see whether they were good bets or so.
I think that'll be definitely interesting to look back over time and see what what was brewing during COVID, during the quarantine, and how that has come to fruition afterwards. So let's look a little bit more at sort of the macro perspective. What are your positions today on how what's going to happen with unemployment? What's the global outlook going to be? And then let's sort of move on more to valuations and a more sort of tangible micro level impact. So Kadeem, maybe first up to you. We're all in three different geographies here.
Right.
What's the macro outlook? How are you feeling about that? And what sort of time horizon are you looking at the moment?
Yeah, I would definitely say that, I mean, really looking at the US market, there's a lot of issues that have arisen or are becoming noticed now that people aren't making the same amount of money that they used to be making before, and cash flow isn't the same. So, for instance, I think that there's going to be a huge debt crisis, which is going to affect companies from the top going all the way down to the bottom, whether it's the huge multinational corporations to like the little companies too. So I think that something that really needs to be a focus over the next couple months going into the next year is just like your debt ratio and covering your debt payments and everything like that. I think that a lot of the companies will kind of struggle with that over time, causing a lot of the less prominent businesses to go out of business, which will create an opportunity for the larger businesses to acquire more companies in the coming years. I think that for that reason, my horizon is more of a long term. I think that if you're investing in a startup, your horizon should be long term. Like right now, we're going to go through a slump, and it's going to be an economic slump. So in the next coming years, your investment might not have as much value as you would want it to be. But if it's a good investment, then in the long run, it should realize its true value. So I think that the horizon should be more of a long term, and then looking on the macro level, I think there's going to be a big issue with debt and managing debt among people and then also companies too.
Yeah. So, Kadeem, is it fair to say then that you sound sort of pretty bearish on the whole macro side, but at the same time you're sensing opportunities and a sense of scope for acquisitions in the startup world and in your world of business?
Correct. So yeah, I'm definitely very bearish in the immediate term, but I do think that when you look back at the 2007 financial crisis, a lot of good companies came out of that. So I do see the opportunity as the world does change, as we do become a more digital world, as we have become a more digital world, there is going to be more opportunities for these businesses to grow into really large enterprises in the future. But right now, it's going to be more of a hard thing, and it's going to be just really a focus on how do you maintain your life day to day as a company.
Okay, thanks, Kadeem. That's really interesting to hear from you there. So, Boulder, the question over in Amsterdam, are you sharing the same sentiments? How does it look on the other side of the pond?
Yeah, I definitely agree with Kadeem on the fact that this is the time to look medium to long term, right? Don't be too short term focused. Looking from a macro perspective, I think what the central banks and governments have done over the last couple of months have been the right actions. If you see where we are today, obviously looking at public markets, everything feels very much overfilled compared to what we see in day-to-day life, especially with jobless numbers coming in like that in the US. At the same time, they've been trying hard to establish trust, to make sure that people feel trust and some safety and comfort. I think they've done that well. And from here on, it's wondering how we're going to develop from here. What's obviously is very clear is that the thesis about money or how money has been perceived has changed, I think, significantly over the last couple of months. And we have to see how that plays out in terms of debt, but also inflation, deflation. And for now, I really think that the ECB especially has done really well in making sure that they pull the European Union as good as they can together. From a micro perspective, I think it's definitely to what Kadeem also said, is that right now there will be opportunities also in our industry. Crypto and blockchain will probably see good M&A, I expect, over the coming 12 to 18 months. Also, as some companies will probably struggle and find stronger partners. I think that's going to be the main thesis we'll be looking at.
And you mentioned deflation there. To what extent are you really afraid of deflation? How much of that is a big flashing light on your dashboard?
It was the first couple of weeks, but I think that's where we are walking away from that scenario fairly quickly. If we see current inflation numbers coming in the US, I think we had a New York print last week of 3%. So I think inflation is probably earlier on the horizon than deflation, and still I think inflation on the long term, medium run term will also be quite muted, to be honest.
Okay. What about you, Kadeem? Is this something that you share with the guys?
Yeah, mostly I agree. I would maybe come from a more positive angle and say that the whole COVID situation has probably accelerated some of the companies quite deeply, in a sense that they achieved something that they planned to achieve within 5 years. So if we look at Zoom, which we heard quite a lot in the press, there's quite a bit of other companies. We have one company in the portfolio that has benefited, and their roadmap of customer acquisition actually shrank, in a way, not shrank, but expanded, that they had an opportunity to acquire major customers that they plan to acquire within 3 to 5 years. So that's a very positive impact if we look at e-commerce and other ways. The whole COVID situation have made people aware of digitalization and what benefit does it bring. So this is the positive angle. I also do agree that a lot of discussions were before COVID that a new financial crisis or recession will come. How will it hit? And probably no one thought that it will be a pandemic. So now no one is talking, or not. It's not that popular to talk whether it will hit and when again, and what will be the background of that. So there's still that on the table. A lot of cash is being poured into the economy, and in what I see, it might be also stuck within the banks, which are still very risk averse, and will not be distributing capital to SMEs. So how do we keep the economy moving, and then of course the inflation and deflation talk. So there's many angles, and I guess it's a very big separate discussion on that. However, for the technology part, I believe in many cases it's a positive case, which accelerates technological development, connectivity, as we are having a conference online, and you can view it without travel and without significant cost, and be connected all over the world. So it might be moving the right direction.
So this is really, really interesting to hear how you all see the macro perspective, the opportunities, the risks. And I think this is really kind of the right moment then to jump into really understanding now, how will you actually price valuations of companies, and what does this mean? What are the factors that you're taking into account? What are the kind of methodologies that you're working with today, given the uncertainty with, is there going to be a second wave? What's the macro perspective going to look like? So let's hear from you on this, because I think people on listening in today are really curious, how we're actually pricing these evaluations. So Kadeem, maybe you can kick us off.
Yeah, definitely. And I think this is kind of relating to what I was mentioning earlier, that what's happening in the immediate term shouldn't have too much of an impact on the long-term value of companies. So I think that definitely when you're pricing a company, you should be looking at like 5 to 10 year horizon when you're pricing it. So I think that, yeah, what's happening right now might have some impact in terms of valuation, but it won't be in terms of necessarily focusing on the financials. Like right now, the economy's down, so we should price it cheaper. Or more so, it should be focused on, is their business model still going to make sense going into the future? Like for instance, for Zoom, their value has gone up a lot, because now with the future, how people are now working from home, now there's more value to Zoom, because a lot more companies need this service. So they're going to have more customers, and then they're going to make more money, which brings up their price. Versus, let's say, a company that isn't as technologically advanced, which is not really applicable to fintech, they would have a little bit more trouble staying afloat, such as like a restaurant. I actually run 2 restaurants here in Brooklyn. They're having trouble stay afloat because there's less of dine-in traffic, and it's mostly online takeout things, and you have to kind of adjust your business model. So I really think that valuations shouldn't be too much impacted by what's happening right now. I would say that maybe some companies might offer somewhat of a discount to more so push investors to invest money right now to get money in the door, because they might be running out of money. But I think in the grand scheme of things, this really shouldn't have too much of an impact on valuations.
That's really, really positive to hear. So happy to hear that. Giteni, what about from your perspective?
Yeah, if I think I do agree in VC investing, it's a long-term play, and most of the people know it. The key issue here is, or not an issue, an opportunity, is that I think all of the recessions are in a way wiping out nice to have versus must have products and solutions. So it might be very, very difficult for the nice to have solutions to actually fundraise, and they might reduce the valuations quite dramatically. However, those companies that are documenting even growth or a V-shaped dip in their sales will actually have the opportunity to increase their valuations. Because if they come to VCs and say, okay, look, we are still growing, our service is even more needed now, and basically we can manage our resources in a way that we can document that it will be even more needed in 5 years term. Why should we discount our valuation? And since there's so much capital in the markets, VCs will be fighting for the best startups. that can survive, that can manage teams in crisis, and that can document growth.
Super. I think that's a nice message to hear out there. So especially if you're sitting on a fintech which is growing during the crisis so far, and is definitely not just a nice to have, but really an essential service. Great opportunity to get an even higher valuation from what you're saying there. Okay, and then Balder, from your perspective.
Yeah, thanks. Yeah, we're pre-revenue, right? So valuations are always a different discussion than when there's revenue in place, obviously. I think there's two trends we have been seeing over the last 2 years already in the blockchain and crypto world. One, valuations have come down significantly. That has already put more power in the hands of VC and investors over time. Secondly, what we have seen actually since COVID and also maybe a little bit before is that the stronger teams with the decent track records who have been building stuff before and are coming together are actually maybe even raising at higher valuations than before. And let's say that the nice to haves are not raising the capital they would have raised before. I think that's the two biggest trends we are currently seeing in the blockchain and crypto industry.
I think the insights on the track record side, that's really another good one too for teams that are sitting out there and thinking, yes, I can actually go out there and still raise money and go there. And Balder, can you sort of talk us through a little bit more on some of the basic methodologies that you're using for valuations at the moment? You know, what are the key metrics? What are the kind of things you're looking out for?
For us, it's really the pre-revenue phase is really about team for us. Have they been able to execute before? What have they built? How have they executed in terms of setting up the team and the technology? So I think the three T's, we call them together. And obviously also most of these investments we have done over the last couple of months have been token investments, and always these from a valuation perspective are very unknown yet. So we very much understand that these are very high risk. At the same time, we are currently working with a number of teams to make sure that we try to capture the value of the protocol, the usability of the protocol, as we say, the layer 1 or layer 2, over time through that token. So we really try to build a connection between the token and the underlying technology here.
Super. Kadeem, is that the same for you? I mean, is it the team, something else on top? What are your sort of standard measures for valuations?
Right. I would definitely say team is very important, but also something I do consider is timing. And I think that right now timing is especially key. So while I was at 8 Decimal, we kind of had the ethos of like, why blockchain and why right now? So why is right now the right time to implement blockchain or whatever technology into this financial service? And I think that right now timing will be really key because of what's happening around the world and how the world's kind of changing to a more digital world. So I think that timing is also something that's very important. But the team is still, I think, very key.
Super. Nice bit of cohesion there between the two of you on the views as well. Kadeem, shared by yourself?
So I would say, of course, team traction is important. So as from software as a service business line, the key metric would be 100 times monthly recurring revenue. However, in early stages, this might be difficult to determine. So then the composition of the team is very important. But on top of that, since our organization is very sales driven, it's very crucial for us to understand where is the problem coming from, who in the organization, in an enterprise or in a large organization will actually buy the solution. What's driving their motivation? How much will they be willing to pay? How long will they use it, and whether the decision maker will actually use it daily, whether he will delegate to someone, will they need to fire people because of using the solution, will it impact the bottom line by cost reduction or income increase? So there's many factors that we want to take in place, but the key idea, who's the buyer and how much is it worth for them to actually acquire this startup.
Great. So some really good insights there on the valuations themselves. So I hope those are some clear takeaways for people on the watching in. And then I guess it's been pretty positive so far. You've all been pretty bullish, if not on the macro, then on the actual fundraising for startups themselves. I'm just wondering, do any of you have experience of down rounds, and what are you actually doing to prepare for down rounds for companies? And in particular, really, what advice would you give to startups that will actually have to go through a down round during this coming 6 months? So maybe Balder, you can kick us off with this one.
Perfect. No, we haven't been, so to answer immediately, no, we haven't seen any down rounds yet. I would expect there are going to be some down rounds coming months. I think what's key there is that you really maintain a strong relationship with your current investor base, especially when they go and get stuff, as it is right now, to make sure you keep them informed. And what we have been seeing a lot, and I think that was so interesting to see, is that a lot of teams who we discussed with in February and March and had a sort of a set valuation and were trying to raise between 2.5 to 10 million, immediately switched over to a convertible note in a quick notice within 2 weeks' time. So I think a lot of these teams did decide to place a convertible instead of a fixed valuation at that point in time. So the convertible obviously comes to evaluation later in 2021.
Okay, super. And Kadeem, what about for you? Is that something that you're dealing with, or something you have experience of that you could share with the audience?
I don't particularly have experience with it, but I would definitely agree that kind of communication with your current investors is key. Even your current investors could be investors into your down round. So I think that it would be a little bit better to have current investors coming back into your down round. But if you do need to have a down round, then it's very important to keep your current investors in the loop and make sure that they know what's going on and why it's happening. Because it's not the worst thing in the world, but they just at least need to know why you're doing it. And as long as it makes sense for the future of the company, then you'll have the full support, most likely.
Sure. Really nice advice there. Stay close to the investor, and not the end of the world. And yeah, great. Thanks for sharing that. Dennis, any experience on this side?
Yeah, maybe some personal. Down round is better than no round in any way. So
yep.
Probably if you can survive without the down round, you should do that. Focus on the revenue. It might also, basically, if we look into deeper what the down round means, it means that the first promise for your investor, you have not delivered on that. So that's already a big red flag. You budgeted, let's say you raised for 12 months, and you said you'll have a certain amount of sales, product, and so on. And what changed? Did the market change? Is it a market issue? Did you fail as a product team? Did you fail as a sales team? So which of those are different? And then you need to dig deeper. How will you fix it? And do you actually need now a round? Can you focus on sales? If you have not been doing sales and you promised your investors that you will have revenue, and then your expectation now to fundraise and still not do sales, then maybe you should not even fundraise anymore.
And this has been really good to hear from you all on this perspective. You've also said about your thoughts on are you going to be still investing now? Do you see opportunities? And I think you've been again pretty positive on this side. Dennis said at the start there that they've made 3 investments since the start of COVID-19 and the quarantine. So I think let's look a little bit wider into the VC community and your experiences with peers and partners and other organizations. Is there money out there? Is there powder to burn? What's your general feeling in the VC community? Balder, what does the picture look like there in Amsterdam?
Yeah, we obviously invest on a European and US scale, global scale mainly. But looking around us, yeah, I think March was a big shock for the industry at first. I think everybody was really taking a step back to have a feeling, okay, what's going to happen with valuations? Where are we going? After that picked up fairly quickly in terms of public pricing, I think everybody felt more comfortable over time. And we ourselves have done 2 deals since COVID. And looking around us, we're seeing people deploying money when they see fit. And what I said before, I think it's if the team is right and the solution is right, and then they have a decent track record in executing, then people are more than happy to deploy money, even maybe at higher valuations than before. But the nice to have are probably struggling more over time at this stage.
Okay, and Kadeem, what's your view on this, or the word from the community there?
Right. So I haven't been doing direct investments for a while now, but I've been working with some private investors who are looking to get into the market. And surprisingly, I have seen actually increased interest during this time period as investors are becoming kind of more wary of the markets. So they're looking to do some private investments and alternative asset investments. So I have seen interest into the startup space and investing in the startup space with what's going on still.
Great, good to hear. And Gitenis, then, from your view here.
So there might be quite a bit different angles on this. So I personally saw some of the investors actually stalling and procrastinating on making a decision, checking how it will work out and whether it will work out. So it's a nice strategy once you have the term sheet out there. For some other parts, it's also if you are considering angel investors who's running their own business, they might be really interested in actually funding their own business rather than investing into more or getting more risky exposure. Some of the VCs might actually reserve capital for their portfolio, not to forgo the down round. So there's many angles to be considered when we talk about is it a good time to fundraise. And personally, for us, it's our first year as a VC. So we have an ambitious goal of investing into 70 promising startups, and we are actually actively looking for opportunities here and believe this is a good time, and we will find people, talent that was made redundant, that had the brilliant idea and now they have a market push into actually executing it. So I feel it's a good time for VCs who have a fund in place and are in their early stage or in their initial stage of disbursing the capital, whereas it might be a more harder part for the VCs that are divesting from their portfolio.
And I guess the audience out there, people are thinking, it would be great to hear some real examples as well of what other people are doing. And I guess, so, if there are examples of sort of what looks like an extremely risky bet at this time during COVID-19, or something that maybe looks like a really smart bet, any examples that you could all share from here? Who'd like to go first? Maybe Kadeem. Anything you've heard out that other people are doing?
Yeah, I mean, in terms of investments, I've heard of a couple. I wouldn't necessarily say they're risky, but they're not really investments into fintech. I've seen just the way that people are approaching the alternative asset space is really like a big thing right now. So there's some companies I've been working with who are looking to invest into properties and distressed properties and buying those out, and also just some other investors beyond just looking at the venture capital space. They're also looking to invest in ultra rare cars and things like that. So I think right now, just in general, investors are looking for that alpha, and if you can prove to them that your company will provide them that alpha, then I think there's a lot of possibility to raise money.
Okay, good positive note to end on there as well. Thanks, Kadeem. Gitenis, what about you?
Yeah, I'm thinking, and there's so many ideas popping in my head. But I would say if we're in a fintech conference, the key idea: how can we make liquidity in the market through technology and reduce the whole manual labor burden? We are all in digital economies, and how can we employ those digital economies on making sure that we can disperse funding for startups, for SMEs, for other businesses really quickly and improve on that, and how to use the technology and the infrastructure that is already in place, and make it better, make it faster, and make it cheaper.
Good stuff. And Boulder, what about you?
Yeah, I think most of our bets are already rather risky, so I'm not looking for additional risk here. I don't think we're going to be more risky or less risky at this phase. It's as we said before, right? VC investing is a long-term game, so we're not changing anything here. What I would expect is what Kadeem also said. Probably we will see some distressed assets or distressed companies over time, and I think that might open up opportunities for venture capitalists to deploy capital at reasonable valuations, as capital has become more scarce in the short to medium term.
Assets there, or firms that are really suffering from COVID. If we think a little bit about sort of very practical advice for startups that are out there and listening in, if you're suffering from churn, if they're suffering from serious churn, losing clients, what would be your practical advice for these startups? How to approach this? What would be what would be your ideas on that? Kadeem?
Yeah, I think that it's easier to say than it is to actually do it, but it's keep your expenses low and increase your income, right? So it's kind of focusing on those two parts. So how do you decrease your costs? So whether it's decreasing the headcount, office space, which you don't even need office space anymore, different things like that would be really important to increase your runway. But also, I think it's really a big thing right now for companies is like their main focus should be sales, and how do we increase sales during a down economy? And I think that's really the biggest thing there. But then aside from that, I forgot the third point I was going to make, but really the key thing is just increasing sales and decreasing costs at the same time. But also, the third thing I was going to mention is that also when you're raising money, in order to make sure that you keep your runway decent, I would say just know how much you need to raise, nothing more, nothing less. So a lot of companies might come out here asking for $20 million when they only need for the next year maybe $5 million. So it's a lot easier for them to go out and raise the $5 million and have enough money to last a year than trying to raise $20 million at an absurd valuation that causes a lot of investors to not be interested. So I think it's kind of a two-handed thing where it's like you kind of have to manage your own finances, but also you have to know to ask for the right amount at the same time.
Okay, good insights there. And you mentioned office space. I guess this is something that's really going to be changing with sort of post-COVID, with companies being used to working from home. People, not necessarily wanting to have that expensive real estate in the center of the city. Boulder, how do you see that? And again, your practical advice for companies suffering churn. Is it the same of keep pushing the sales, focus on costs? What are your insights there?
Yeah, about the office space, the first interesting thing is that most of the teams we are currently working with already work mostly remote or distributed around the globe. So most of these companies don't even have an office, so that's cut out quite fairly quickly. I agree with all points made by Clark there, with Kadeem, sorry. And additionally, I would argue that being creative about your top line, can you squeeze revenue from other sources, maybe more digital sources, as you are probably seeing churn on the other side. I think that's definitely an add-on. And secondly, I think you can also ask for help under your current investor base, right? Don't talk about valuations, but as Kadeem said, right, what kind of money do you need for the short to medium term? And let's ask for help and talk about the valuation at a later point in time. I think a lot of investors are willing to help companies that show small to medium growth, and so go out there and be creative.
Super, good message as well. So thanks for that. And Dennis, what your thoughts?
If we're talking about churn, I guess you need to understand where is it coming from. So talk to your customers, see why are they choosing a different solution. Is it no longer necessary for them to have the solution in place? And maybe since you already have built the personal relationship and they have trusted for a period of time, maybe figure out how your solution or an adjustment to your solution can help them impact their bottom line or impact their personal KPIs. So if you're experiencing churn in a B2B outset where you are selling to larger companies or even mid-sized companies, talk to the customer, figure out why are they reducing or cost cutting on you.
So a lot of talk on or focus on the customer there, of course, which makes a lot of sense. And we've also touched quite a bit on investor relations, and you all, I think all three of you have touched before on how important it is to keep your investors updated. Again, perhaps you could go sort of super practical, be really practical in the sense of, what does that mean? What does that mean to really take care of your investors during this time? What practically you need to do? How much time do you need to spend with them or communicating with them? What are your expectations as investors? What do you want to see from startups? Let's go with Balder first.
Sure. Perfect. Sorry. Yeah, first of all, I mean, on our side, we always deem it extremely important that we have a good relationship with our investments. We can always go out for let's say a beer or just have a normal relationship with these people. So even if it doesn't go well, that we're still having this one-on-one communication and we still want to see these people. So I think that's first. So our door is always open for people to come in and give us a call and ask for help. So some teams, indeed, find it harder to communicate well, right? So just make sure that there's news, there's a small call. Most of the teams update us via a sort of a bi-weekly or monthly newsletter, which is always appreciated. Make sure you get that extra attention spent from that investor around that newsletter, so you really are top of mind of that investor. So I think it's definitely underestimated, but some teams do it very well, and I think they will get the fruits in a later stage of their company.
Super, great insights, thank you. And Gitenis?
I think the first expectation is to actually build trust. So even before contracting, it's all about trust, and then sustaining that relationship that the startup perceives the investor as value-add investor, and the investor gets the right amount of information or is asked whether he can help with any business going forward. So it's a in a way two-way communication, but a startup needs to understand that as an investor, typically an investor has quite a big amount of portfolio, and a startup probably has a bit less of investors. So they actually know personally who can they reach out for what help and so on. So this communication, I think, is the most important in general.
Yeah, again, great tips, and thanks for sharing those. And Kadeem, your expectations there.
Yes, I definitely agree that communication with the investors is pretty important. As an investor, there's beyond the investor helping you out, an investor's friend can help you out. Investors know other investors. So let's say if your company needs to raise a quick round, they could probably name another 5 firms who might be interested in investing in you. So I think, again, it's really key to have communication with your investors, telling them exactly what you need, how they can help you out, because they are very busy and they have lots more companies to worry about than you do investors. So I think it's definitely key to have open communication with your investors, letting them what you need, and just keeping them up to date with the status of your company and how it's been adapting to everything that's going on right now.
Fantastic. Thank you very much for that as well. So we're coming towards the end of our time together on this panel. So as a quick sort of recap in terms of our objectives, we started off by saying, everyone was looking forward to hearing that there's an enormous amount of money still out there. There's dry powder to be burnt. There may be a bit of a pessimistic view on the macro environment, but at the same time, in terms of valuations and moving forward, that I think our audience has a lot of scope for positivity based on everything the three of you have said. So thank you very much for that. It's been great to go through the valuations and really picking up your tips and tricks on at least on how you're looking at valuations. So we've looked, again, this sense of long-termism, maybe not too much impact in the meantime, discounts now to get things moving, timing is still key. We've said also traction. We've talked about the track record. So a lot of these really important factors, and then also some really practical tips for the audience in terms of expectations for managing investor relations and keeping things good and clear. So that really wraps us up for today. Thank you very, very much for joining us from the different parts of the world. Thanks and goodbye.
Thank you, Alexander.